Jeff, no Facebook post on this last week about fishing. What is it that you do? I mean, how do you survive on a weekend without fishing? I'm not sure I understand.
When I'm not fishing on the weekends, Dave, I'm strategizing about my next fishing trip. That's how it works. You got to put in the time and preparation. You know that.
I thought you were going to say you talk about the content for the next episode of the Income Generation. That would have been an answer that our viewers and our listeners really want to hear. But I don't want to delay because our next guest always has a lot to say, and sometimes it can be borderline radical. And that is Harry Dent, author of 0 Hour and the editor of Economy and Markets newsletter, which is all available for free at harrydent.com. Harry, thanks so much for being back with us here on the Income Generation.
Yeah, good to be back, David.
So, Harry, it's so great to see you. The last time we were on the show together, we were both scratching our heads saying this thing is a bubble, what's going to happen? And now it's gotten even worse. More debt, more money today, MMT, they're printing up money through fiscal and monetary stimulus like no tomorrow. And so at some point, the Fed's going to taper. And what do you think is going to happen when that happens?
Well, we already got a taste of it. They tapered in 2018. And guess what? And they're acting like, oh, we're over the crisis now. We can pull back a little bit. I mean, they've been thinking that all along, by the way. They thought this stimulus was going to be temporary. We just had a temporary little crisis. And we just have to get over that cliff. And of course, they've been printing money nonstop for 12 years now. So the only time they did pull back was in 2018 and immediately had the repo crisis. So before COVID hit, they had to pump money back in strongly because the markets started to go down without daddy giving them more crack. And then COVID hits, and oh my God, I mean, COVID really was the ultimate trigger, but what they did was it was so strong that they just reacted, 10 times. I've calculated now, and I've got to up it again with the new 4.1 trillion infrastructure and social program instead of the 2.2 originally or whatever it was. But we're up to 55% of GDP since the repo crisis, the monetary surge, and now the even larger fiscal surge on top of it. 55% of GDP stimulus in a year and a half committed. What are they going to do next? Are they going to do 100% GDP? Are they just going to print 20 trillion or build roads, a bridge over the Pacific?
Sure. Harry, the answer is yes. Yes, that's what they intend to do. So the answer is definitely yes. Harry, we need to take a quick break. As soon as we come back, though, I want to talk to you more about that. And of course, what could get in the way of that or how long it might take to get there.
Welcome back to the Income Generation. I'm Jeff Small, and I'm here with my co-host David Scranton and our very good friend and repeat guest, Harry Dent. Harry, we know that recently the Fed Chair, Jerome Powell, said the current path is unsustainable, but I never thought in a million years I'd hear you agree with Jim Cramer and say, buy this market. So tell us why you feel that way.
Well, no, I'm more like, you just kind of have to stick with it and be quick to get out because, what I do in my newsletter very seriously is I tell my subscribers when we are at a point where we could be peaking so people can kind of get prepared to move. And we are at one of those points. What I would be looking for here is the first sign that this thing may not get to 4,700, that high target, or maybe ending is that we break the trend line, the bottom trend line from the COVID low in March of last year. That hits about 4,000 on the S&P, so about 5% down from here. So if we break that, that's a wedge that's rising, and that would say, okay, we're at least likely to go into a correction. And then that correction, if it goes low enough, could turn into a top. So that's all I'm looking at. So I would be getting cautious if that happens. If that doesn't happen, then the trend is your friend. That this thing, literally the long-term resistance, the only resistance to this market that I can find from all the best charts is that 4740 target later this year, and that could be hit as early as late June. Let's say we have a minor correction here, like down to 4,000. If we turn back up and break the new highs after that, I would say, yeah, 4740 is a good target into June or July, something like that. And if it hits that, that's when I think the smart money will see the same thing I'm saying and say, okay, this is enough.
I was just going to
because they're not going to stop. They're not going to stop.
Thanks so much for being back with us, Harry. As usual, it's our pleasure. He's got a lot of experience in this industry. I think slightly more than actually either of us. He's got us beaten by a year or two. And that's Scott Mclean, CEO of Mclean Advisory Group, located in New Jersey. He's author of the book, The Three Blind Mice. Scotty, it's great to have you back, man.
Thanks, Davey. I appreciate it. Thanks.
Hey, Scott. You're welcome. You're welcome. Nice to chat with you today. Glad you're on the show. Hey, listen, we're talking about passive income today. And so tell us, in your experiences in New Jersey with your customer base, do they sleep easier at night knowing they've got income coming in without them doing anything?
You know, it's beautiful, Jeff, which is why I switched to passive income for especially for seniors, because they want to free up time. They want to enjoy their families, their wives, their kids, their grandkids, and not having to struggle so hard to work for money, but they can enjoy an income they don't have to really worry about. They can worry if they want. That's human nature, but a nice stream of income to have, do what you want, when you want, and control your own destiny versus having to work and have your work control you. Big deal. It's a big deal.
Yeah, that's a huge deal for them. I mean, it provides a quality of life and enables them to focus on their goals in retirement, knowing their income is taken care of, right?
Yeah, I mean, why go 9 to 5 when you can choose to go 9 to 5? In my case, I can retire now, but I love what I do like you do and like Dave does. But you know what? I don't need to call upon that passive income right now. But if I needed to, it's there.
Scotty, why don't you tell us, since we're talking about passive income, what type of vehicles you utilize to create that income and that peace of mind structure for the customers that you work with?
Well, Jeff, there's a lot of cool, great tools in the toolbox, such as you can talk about bonds. They pay nice dividends, interest payments twice a year. You can get preferred stocks, whether they're cumulative or non-cumulative, depending on that investor, because they do go up and down in value. You're looking at maybe BDCs or business type of tools. And then, of course, real estate investment trust or REITs. So there's a lot of different tools that work differently. But the beautiness, Jeff, is not just buying the right tool for your viewers, because you're going to run out and go to the Walmart and buy himself a nice passive dividend income tool. Well, they could buy the wrong type. So it depends, again, of the risk level. Each one have different risk levels. But I do enjoy watching the dividends come in. It's like a lottery. The check keeps coming in. And assuming the companies are strong, well, that's a great tool.
So an investor, Scotty, really can't do that themselves. That sounds pretty sophisticated to me.
Jeff, they can do it themselves, but it would be like, painting the walls with one arm. Your arm's going to get tired after a while, or you could make a mistake. Very dangerous to try to do it yourself unless you really study up on it, Jeff. I don't want to say they can't. I want to say they probably could, but they could make some huge mistakes and then throw their hands up and say, I'm done. And then they could catch themselves like a knife falling. Not a good choice.
Scott, thanks so much for being back with us.
Thanks so much.